at the heat map today, and we've got another like U shape on the chart. This is like the ugliest U. It's not an L. This shape. It's not an L. It's a backwards L. We have like a backwards L, ignoring auto manufacturers and home improvement, which is like real estate and, you know, spending related. A lot of red in pockets of this area. And it just so happens that a lot of that happens to be the Dow. The darling of the Dow and the darling of the whole S&P 500 right now is Apple and Tesla. But for the most part, there is some divergence, some continued divergence. This is a theme that's been going on. Divergence in the stocks and companies that are performing well today versus the ones that are not. Now, REITs are up today. That would make sense with inflation coming down. Tesla, Home Depot, some financial companies, but not all. Interestingly enough, asset management, that makes sense. And all the technology is up. So it's an interesting kind of divergence in terms of what we're seeing here today. So we're going to be getting into all of that. We have, again, on our radar here today, we're going to be taking a look at many different charts in preparation for the FOMC meeting minutes. I'm sorry, not meeting minutes. The press conference, as well as the dot plot, which gets dropped at 2 o'clock. So just to reiterate that at 2 o'clock, we get the economic projections, which means that 2 o'clock is actually really important too. Sometimes you see 2 o'clock come out and nothing really happens, but 2 o'clock today is going to be important. 2 o'clock, we get the Fed funds rate, which is not going to be the surprising part. Everybody knows it's going to come out at 5.5. What's going to be the important part is this right here. The statement and the economic projections. And then, of course, the 2:30 press conference will also be important. But it is setting up to be an incredibly volatile next few hours because this dot plot or this press conference will give us truly the thought process of the Fed. What I love about the dot plot is that it gives you votes and numerical values almost that can show you what the Fed is voting on, what they think is going to happen next with interest rates. None of this, jargon from Jerome Powell that can be taken different ways. That game can be played every single month. We talk about how it seems like the Fed chair always kind of has something to say for both sides. We don't want to cut rates too soon because we want to keep inflation under control. But at the same time, we don't want unemployment to spike and we want the economy to stay strong. So we'll be looking to cut rates. And it just gives you this nothing burger. But today we get the projections. That is where things get interesting today. And where either this rally that we saw today is going to explode higher from here, or if we see some sort of pullback or reversal due to the material that we get. So going to be a crazy next hour. So we're going to be Chris Pulver in on the conversation as we count down to FOMC. So we'll go ahead and say hello to Chris and bring him in here now. We'll skip the ad because we just did one recently. But what's up, Chris? How's it going, man?
Good, Nick. Happy, crazy CPI FOMC day, as we expected.
Yes, today is absolutely crazy. We had this morning, things were wild with the CPI report. CPI came in cooler than expected, to many people's surprise. I think Frank and I were talking about this. You had a lot of things that would have suggested that inflation could have come out hot today, like wage growth and jobs data that was higher than anticipated. So I think that's what we got, kind of such a wound up high volatility day, is simply because the market expected CPI to come in kind of hotter than anticipated. Again, wage growth, hot jobs, there were some indicators there, and this shrugged off that concern, and inflation came in light. Dollar dropped. Everything against the dollar is up today, and stocks, of course, are flying up over 1% for the S&P. But Chris, help me out with this. The Dow flat on the day on what should be an incredible day for the Dow, I would have guessed. What's going on here?
It is a really interesting, index divergence. SPY's up Qs are up, Dow, but as you know, I mean, Dow is price weighted, not market cap weighted. And what is carrying the load? It's market cap. Did you
Yeah.
notice that Apple the
Mm,
last 2 days is now #1 in market cap? It's bigger than Microsoft and it's bigger than Nvidia again. So we're jostling for leadership on who reigns supreme. But it's still the Fab Four. It's still the Mag Seven. And the Dow is not priced that way. The Dow is a price weighted index, and some argue that that's an old school way, an archaic way to do it. But the Dow is kind of more of a reality check for it doesn't matter if you're Apple or Microsoft, it's price weighted. It has
sure.
nothing to do with market cap weighted when it's a $3 trillion company, where right now you have about 5 stocks that are concentrated about 30+% of the S&P.
Sure.
Nasdaq, same thing. So it's highly concentrated, as we know. I think this inflation data today gives the broader market a chance to step up and carry the torch a little bit to continue with what the Mag 7 Fab 4 has already done. Now, I don't know if that's going to happen. It's possible, but price action today, I saw a question in the chat, fundamentally does it matter for intraday trading? I mean, look, I think that if I go to my charts today, we're already up, $7 roughly from the close yesterday to the high today, just shy of 544. So we have a $7 move from. Let me use my little drawing tool here. So I'll just have to redo it. You can see my crosshair. So 537 was a close yesterday. We have a peak today around 544. That's a $7 move. The average move for the S&P is around $4. So we've already stretched nearly 2x what's expected. And I think that with 2 o'clock rolling in here in 20 minutes, Powell's press conference, this gives the market an opportunity to, one, come back and test the open of the day and see if this is going to stay bullish, or two, come back and fill the entire gap and be a big disappointment. But I truly don't know how Powell is going to be super disappointing other than saying, we don't want to cut rates. I just don't think he's going to say anything like that. And I think the market's going to continue to push higher. This is
Mm,
path least resistance. Another thing, we talked about this yesterday. Let me get my drawing tool back up here. If we close higher or we breach last week's high, the highest probability is that it stays higher for the week. We may hold, we may not take out last week's low, but I would imagine that with this momentum and this 1% push, unless we absolutely smoke that gap all the way back down, we're going to
mhm.
close higher for this week, and it's just going to be another melt up.
Yeah. Yeah. I mean, that's like it does seem like it's in frenzy mode. And when you're in frenzy mode, it just goes a lot longer than people think it will,
Yeah.
myself included. I just want to run you real quick through this thought process I have. This is my game plan for the day. Chris, I have some things that are working out great, some things that are not working out as well. So this is just my loose game plan, and maybe you can follow up with yours after if you'd like.
Yeah.
Um, if we get a dovish FOMC today, meaning whether it's the press conference, dot plot, if the market takes this as a very dovish FOMC event, which is, as you just mentioned, kind of the consensus to a degree. Inflation just came down, jobs are looking okay. That's the question. So I have a TLT position that if it does jump, if we get a clean breakout here, I'm probably going to sell the 20 deltas, 20 delta calls against my TLT position, which is officially in the green, Chris. I've waited, just like 100 years. It's officially green. And yeah, so I might be selling calls against that if we start to get a bit overextended, but right now I'm just going to let it do its thing. In terms of other things that I've got going on, I am long VOO and XLK, but I have covered calls. But I no longer want the calls with the cool inflation data. I like the charts. I like them long, but I still have calls to deal with. So if we get a dovish, if we get this thing that just comes out super dovish and we just explode higher in the indices,
Mm-hmm.
looks like I'm probably just going to be taking profits via covered calls on my
Right.
positions, which is fine. I'll just look for a chance to re-enter. And then I'm also I have a gold position. I'll be looking to trail stops on gold. If we get more upside, basically, if we squeeze higher today, I'm going to be trailing on some of my positions and selling covered calls against my TLT trade as well. So that's that. If we get a hawkish FOMC, if we get a surprise, if we get a little bit of a reversal day, I'll be looking to sell those calls that I have on XLK and VOO for a smaller loss. I'm floating some red on those. I'll show you those now. This is the P&L. Um, so I've got calls that I've sold that have kind of locked me in on some of my positions here, capped my upside. If those drastically change today, I might just close them out for those specific calls for a loss, just so I can stay in the positions, because I like the scenario. I think we have more upside, even though yes, we've been on squeeze higher for some time. This inflation figure could excite the markets, and any hiccups in the Fed jargon, I'd be potentially trying to hold on to my positions. And then
Sure.
finally, if gold completely reverses on a hawkish kind of spiel today, if that happens, then my stop loss is in place below the lows. I'll take a loss on that. So that's my game plan. I just wanted to run that through for anybody who is just tuning in, and also to share with you, Chris. That's kind of my game plan. I'm curious to hear what is on the radar for you as we about 15 minutes out from the dot plot getting dropped.
Yeah. So the thing I'm really focused on for the next couple of hours, I'm just going into the SPY. I'm going to try to look at some price action today. Um, I'm just going to let the 2 p.m. kind of rattle the markets a little bit. I'm probably looking to trade. If I trade anything, it's going to be from 2:30 to 4 o'clock. I'm going to try to get a read on
Okay.
price action during Jerome Powell's press conference. It really has nothing to do with what he says. It has everything to do with what price is doing. An easy way to do that intraday. I mean, I've got my drawing tool back up here. So, this is the open of the day. We had our, gap open with CPI data 8:30. I could see price getting retested and then ripping higher, and then even through the press conference, possibly going higher. A number that might stand out today might be 550. I just haven't seen it pop up on my platform yet. Right now it's kind of maxed out around 545. But if I start to see some more gamma levels print to the upside, it might give me the opportunity to buy an at the money call, even a 1 to 2 strike out of the money call, and pay a little bit less for it for a 0 DTE, and see if there's some fireworks to get like a $3, $4, $5 move during FOMC. That would be if I'm going to the upside. If we break this low, right here, and we're going to try to have a gap fill today, I would probably do just an at the money or 1 strike out and see if we can get a movement back down.
Okay.
That's probably plan B. If I'm looking for a bearish move, that's probably plan B. I would imagine that the market's going to try to get back to the highs again, maybe stretch a little bit higher towards this 545, which gives me an opportunity. Let's say I'm correct and price comes down here, a little bit of noise during the rate decision, Powell's press conference, and all of a sudden price is pushing back up here. If I can get like a 541 call, and this trades up to 544, 545, that's a $3 to $4 move. I could probably pay less than $1 for a call option and maybe turn it into a couple bucks of profit. The flip side of that is if we break and try to close today's gap, then I'll probably do something at the money. But long story short is I want to see confirmation. I've already this is how the trades went this week. I'm already up almost $8 of credit to start off the week from Monday per contract. I was long and short the SPY. I was long and short the Qs. And I also had an Oracle trade for earnings that I did with actually Frank. I think we did it yesterday. And all 3 of those trades were winners today, and I went ahead and
Nice.
protected profit. So I don't have to really deal with any of the drama of FOMC, but I'm looking for a potential trade for a 0 DTE, or maybe going out to tomorrow. The one thing I didn't like though is I was looking at if I did like a long strangle where I want to go both directions, it's gonna ask you to pay too much money for it. So even
Sure.
tomorrow or Friday, it's asking you to pay like $3 or $4. No thanks. So I'll take
Yeah.
my chances with maybe just a quick 0 DTE trade, and see if there's some price action I can read and get a good vibe for. Otherwise, I'm up, $7.50 to $8 for the week already. I don't really need to do much. I mean, the account is doing pretty solid. You had mentioned TLT. I'm up about 80 cents per contract on TLT as well,
Oh,
which is
nice.
good. And we'll see if there's more to run, because I do have, I'm kind of uncapped to the upside as long as TLT gets some legs.
Yep.
I also had one of these accounts that I took in and absorbed had some pretty rough positions, but a couple of those actually got out for break even or better.
Nice.
Robinhood, for example, for 600 shares of Robinhood that was upside down thousands of dollars, came back to break even. So there's been some good things happen in the last 3-4 weeks, and melt up wise, I mean, we will see, dude. I mean, 550, 555 is reachable to the upside. One interesting trade that I have is it's a fancy little trade with options. It's a call condor,
Mm.
which just means I'm risking about $400. I'm going to try to see if this is an SPX trade, but I'll show you right here. So SPX trade here. If this trade, let me go into the trade section. This is out to June 21st. Let me try here. Yeah, June 21st. So you can see it where it is right now on my chart. So this is a bull call spread, which means that price is going to max out here around $5 of profit. And then this is a bear call spread for a $10 risk. And so I collected about 40 cents on the trade plus my max profit of $5. So there's a sweet spot in here, Nick, that if somehow price starts to fade back down just a little bit, not a ton, but maybe 10, 20 points on the SPX, then this ideally finishes with a winning bear call spread and a positive bull call spread, which gives me maybe $2 to $3 net profit. So that could be a lucky trade. I set this one like 30 plus days ago, but
Yep.
we'll see. It was actually interesting, a 15 delta when I started, and now it's sitting here at the money at a 50 delta. So clearly the price has been drifting high enough that this position is threatened. But one thing I always kind of rest on with option trading is about 70% of options finish out of the money,
Yep.
which is why it's better to be a seller than it is to be a buyer.
Right. And again, we'll see how that plays out. I think that as you get closer here, just a reminder to everybody who is tuned in, we've done these FOMC events on stream for years now, really. But we have always talked about, at the 2 o'clock mark, if it's a Fed meeting minutes or something like that, you may see some volatility, but to wait till the press conference. Today, I don't think it's just that. I think 2 o'clock is a big event and 2:30 is a big event because today we get the dot plot, which is not always released, but that dot plot will give us key insights into what the Fed's voting for in terms of rate cuts or not rate cuts. And so, again, I mean, as we count down the minutes, you are talking about an event that has the potential to either completely reverse what we saw this morning or completely continue or just go in every direction. I mean, it really can do whatever it wants in the next hour or two. So just expect volatility and you'll at least be aware that it could move violently in either direction. Chris, I was also kind of just thinking up in terms of where I'd like to, for me personally, with my VOO calls and XLK calls, if I do want to try and get out of them, what am I going to do? How am I going to when am I going to take those losses? I think right now what I'm leaning towards is if we do get some sort of reversal of the day, which may happen, may not happen. If we do get that, then I might look to go ahead and realize those losses at a much less loss than what it's currently sitting at. That way I can stay in the trades because I like, my thesis on the indices has changed a little bit since this morning with that inflation number coming out cool. I don't want to fight the thing. And if it wants to give me a chance to exit those calls, then great. And if it doesn't want to give me a chance to exit those calls and this market just rips through, then I am just going to be locking in profits from my buys in April. And I'll just accept that, hey, you know what? I missed some of the upside, but still a great trade. XLK, VOO, I will take those all day long. So ideally, we'll get some volatility here in the next few hours that would allow me to exit some of those positions. I know also, of course, a lot of traders out there asking about gold here. What are we thinking for the dollar index? What are we looking at for gold? For me, this morning was a nice, kind of confirmation that, at least for now, support has been found on gold. You've got the 2,300 mark holding well for spot price. This is going to be, if we get a green candle today, that's going to be our third green day after this big sell-off on the fears that Chinese central bank or the Chinese central bank might be slowing its buying or reportedly has slowed its buying. That caused a lot of fear in the gold market, but I picked it up on that pullback. We'll see where gold goes from here. Silver's also up 2.2%. Chris, do you still have a position on silver or gold? Are you trading these ones at all?
I'm long in both, man.
Oh,
I
nice.
am in, so GLD, I'm maintaining. My first tranche was right here around 212, and I'm
Okay.
just hanging on to that right now. And I'm willing to throw a little bit more at it, but a couple things I'm watching. So we have talked about gold at length, and I want to also get your opinion on the dollar index because today was probably the clearest day that I've had in weeks about, okay, these levels actually were already on my chart, but it just was so much noise around the dollar that today I'm right back to the same levels. And I think the dollar it hasn't shown us a true direction yet, but we'll get to the dollar in a second. If we go to gold, one thing I'm a little cautious on gold is I think that, yes, we can have indecision on gold. We've had this nice run. This could be a bull flag in the making that continues to go higher. That would make some sense to me. But just in case this is a double top, or just in case this is a very kind of deep right head and shoulders, if we break this neckline and head lower, gold could be projected down to about, I need to go to XAU, but gold could be projected to around 2120 or so. So right here, because we have a little bit higher high, so left shoulder, head to neckline. If we have a neckline right here that's setting up that right shoulder to drop, I'm going to show you how. There's two ways. I can either look at this as a double top because we didn't close above that high. So if this is a double top, there's my low. And then if we break that low again, get that right there. So we break that low again, that would project us down to around 2130 to 2120. If we have a head and shoulders trade, we break that neckline. We do the same type of thing, probably around 2120 to 2130. Also, that's trend line support on gold. Now, all I'm saying is that's my second level to buy gold. I am still liking support at 2300 or so. I'm long on GLD at 212, but I would be looking at that level to kind of finish out a move if we're going to see a downside at all on gold, 2130, 2120, and whatever that translates into to GLD, I'll just pick up another chunk of shares and I'll dollar cost average in and see what gold is. But I still like silver better. I truly think silver is a better technical trade. Silver is not looking like a reversal pattern, but more so just a little bit of a pause. Maybe this is just a bull flag in the making. There's very strong support here at 26. I don't necessarily think we're coming back to find it. I think that we could be looking at a trend line support here and just consolidate on silver until hopefully another chunk higher. So I like silver better. And part of that is still able to catch up and maybe outperform. But the nice thing is I'm switching from option contracts to now ownership. So I don't want to be as time sensitive on gold or time sensitive on silver like I was with my kind of leaps with the option trades. Now I'm just looking to own SLV, own GLD, and then sell covered calls against it to lower the cost basis. Keep it simple. Yeah. Dollar index, dude. What do you think? So I've had these levels on my charts for probably the last month or two. And today is kind of the first indication that this market does not want to get above 105.60, nor does it want to get below 103.90. So I still think I'm torn with any type of clear direction on the dollar outside of range trading. And look, it's summer trading, Nick, so we might see range trading still on the dollar, but holy volatility, man. I mean, we had a huge move up last week on the dollar that today is pretty much taking it all back and found some efficiencies. So to me, there's really not a lot of longer term decision making or direction or momentum on the dollar index. It's just pick your battles, see it be choppy, and be careful on those dollar crosses because they're all different. It's like not every dollar pair is great. I know we looked at euro dollar this week. Now it doesn't look nearly as good. There's some it's ugly stuff.
There's some real divergence on the dollar kind of different options that you have out there, because you have like the euro stories muddled a little bit with the parliamentary stuff that went on, and then you have just kind of unique components to each one of these. The Bank of England, I think they also have elections going on, and they're talking about rate cuts. They have their own politics, and that's the thing about the dollar index itself, which if you trade ETFs, you can trade things like UUP. That's an option. It's pretty thinly traded, but if you want to avoid selecting an individual currency to go against, that is an option. The other option that I prefer is just to trade TLT, because then you can kind of get generally, and I like the yield story a little bit more, focusing on the central bank and the U.S. isolated, if I can, a little bit more with the yields. But regardless, in terms of the dollar index, it's at an interesting level. You've got 104 right here. If that breaks, I mean, if we get more dovish confirmation today, to me that could lead to a slide in the dollar that takes us down to 102.5. You're talking about a retest of these lows of is that the yearly low? No, not quite. I think no, it is. Yearly low is right around here at 102.5, 102.2. I think that if you get a really cool inflation print today and some confirmation from the Fed that rate cuts are still on as we approach this, we are in the middle of the year, you're talking about the potential to really get that breakout. Now, again, that's not what I'm saying I think is going to happen. For everybody listening, please understand, I'm not saying that's what's going to happen. I'm saying let's wait and see. If you get something like that, I'd probably be a seller on rallies of the dollar. That would be my take on it. And then, like you said earlier, until it does that, there's nothing to do for me and the dollar right now, because we're still stuck in this range. You could also, I could make a point where if they say something incredibly hawkish the other way, right? Just
Yep.
depends if what happens with this range and if it's coupled with what I believe would be a strong conviction from the Fed or some data that just really screams in your face. But guys, we are just 1 minute out. Let me not miss the news here. This is a big one. So let me switch over to the all markets view just so we can all keep an eye on this one. We've got indices up here, S&P, NASDAQ, the Dow, which completely erased all of its gains. The dollar index down big, pound, euro, gold is up here in the top right, and oil is in the bottom right, guys. We're about 30 seconds to go until we get the dot plot, which could be interesting here. And yeah, we can go ahead and we'll go ahead and roll our quick breaking news here, if you don't mind, James. All right. Coming in here very soon.
Coming in hot. And again, no rate decision. But did you notice that when we talked on Monday, the market has shifted from a 50% rate cut probability in September to now like 60 plus, almost 70%. So that was a big jump from Monday to today.
Yep, I did notice that.
First reaction down in the indexes. What do you see there, Nick? You got the whole thing up.
Oh my goodness. Yep. So Dow just took out its lows for the day, which is so weird to me. S&P 500 down just slightly. NASDAQ down just slightly. Gold is giving back some gains here for sure. Euro down slightly. Pound down just a little bit. Dollar is rounding out. I mean, these are not massive moves, but there is a bit of a correction to the rally that we've seen today forming. Are you seeing anything, Chris, on your end, news-wise?
I am only watching the SPY, and so like I said, I'm not surprised it came back to retest today's open. So we're still not pushing into that gap yet. I'm just going to sit tight for right now. Again, there's no real rate decision change. There could be some noise here. It's literally minute 0 of the news announcement. So I'm just going to try to get a feel for the day. It could be a very volatile session. I don't know. I mean, at this point, I would think if let me see something. I'm going to price something out right here. If I just did a 0 DTE, because we've gone another couple of hours since my live session this morning, let's go 0 DTE. Let's take a look at, let me bring this price back up here. So get this back out of the way. If I did a 543 call, it's going to cost me $1. If I do a 540, it's going to cost me about 80 cents. So I could kind of strangle this for the day, see if price wants to go somewhere, pay $1.82, and fingers crossed that I get a move that, we drop another $3-4 or we go up another $3-4. Nick, just for fun, I'm going to take the trade. I'm just going to do this in my account here. I'm going to take this trade for about $1.80. Let me see what this is trading for right now. So if I do a 540 to the downside, and then the upside, if we get back up, the highs at 544, possibly breaching new highs at 455. I'd have to go out here. I get $1.40. I'm going to go in for $1.50. $1.50 debit. See if I can get in here for the day. I got filled at $1.48. So I'm in. Right. I'm willing to take the trade live and just see, if we have some wild and crazy direction, I'll be watching very closely, obviously, but it's a 0 DTE trade. And right now, this is all I have in. So I'm gonna monitor this closely. I'm gonna put a close position here around $3 and see if I can kind of double up on the profit. What I need to have happen is price needs to get to 546 or so, or price needs to dump back down and try to fill the gap at 537. If that happens, I get a $2 to $3 move. Let me see, from $1.48. Let me see if I can just make $2.48 credit on the day. I might get more than that, but I'm just gonna go ahead and set my limit ahead of time and see if this will fill. So that will be a $2.48 credit. If I win on the trade, I make $100, and we'll see what happens.
Okay.
So enough. I'm in with something. At least I've got some skin in the game, and it's a small trade, but I'm hoping that there's enough volatility to take us either 1 all the way back down to 537, or 2 up above the highs at 545, and maybe give me an extra $1.50 movement. But we'll find out.
Yep, we're getting a little bit of movement here back and forth right now. I'm trying to, audience, I'm going to ask a favor of you guys. If you have any information, please feel free to share it. We just had this Fed officials' median view of the Fed funds rate at the end of 2024 is 5.1%. It currently sits at 5.25%. So 5.25 to 5.5. So they do expect some rate cuts as an average. So interestingly there, perhaps that's a little bit of the volatility here this morning. And again, if you find anything, please feel free to share in the chat. I'll try and pop your message up so everyone can see it.
Let me see. Let me just go to some real-time news here. Projections: 4 out of 19 saw no cut in 2024. 7 saw 1 cut. 8 saw 2 cuts. So we have a dissenting Fed for the most part. They can't get on the same page, but somehow they all say the same thing. That makes perfect sense, right?
Right. And so that's interesting. It's seen a little bit of movement, but nothing incredibly violent either direction just yet. S&P is giving back not too much, 0.2% of its gains today.
Yeah, it just came back to retest the opening low. Yeah, it'll be interesting, man. I mean, usually we do see a $3, $4, $5 move. I think I went back to this with Frank earlier this week. I mean, we saw like $8 to $9 move up and down last. May 1st was the last FOMC. That was like a $4 to $5, $6 move, and then we had a little push higher. It was like an $8 swing from low to high in the day, and it smacked it all the way back down to pretty much right where it started. So that was for $15, you go 8 up and 7 down. That's a lot of volatility in a single day, and I'm hoping that today kind of matches that, where we've gone up from a close yesterday to a $7 push from close to high. Yeah, $7, but do we crash back down $6 or $7? Do we rally up, 3, 4, 5 extra dollars? I don't know. We'll find out. I mean, look, you don't have a crystal ball, nor do I. I trade price action on days like this, or I stay out, or I'm managing the portfolio accordingly. But there's a lot of wild stuff. Just be careful. The other thing that I did this morning is I also started dabbling with some micro futures in Ethereum and Bitcoin, just because if we have that official ETF for the Ethereum side, just like with Bitcoin reaching new highs, Ethereum all-time highs are at 4,800, roughly 4,880. And that would be like a 30+% upside. So I took a couple of stabs at some micro futures on Ethereum, and I'm holding those out there for if I'm right, I'll make $300-400 on a couple of trades. But I'd like to double and triple that and kind of dollar cost average into those micro futures. But other than that, I think it's going to be a little bit noisy here, Nick. Probably just staying between a tight range on the SPY, 541 to 544. But I do think that it'll be all eyes on Powell at 2:30. Maybe he can say a couple of things. Usually it's a combination of what he says to the Q&A, and the market just kind of runs with it. An easy way that I see trading this kind of every single FOMC is if you turn this into a Heikin-Ashi candle, it tends to eliminate some of that 5-minute candle noise. You let price do its thing, let it close. If it stays red, you're looking for red. Now I do know that if I go back to regular candle here, if it stays red and closes below 541, chances are we're going to have a little bit more pressure to the downside. If I'm sitting here right now staring at red Heikin-Ashi candles, and all of a sudden this goes green, if I want to look at that long position and go green, I could take that trade as well. Just look for a little bit more confirmation instead of getting some of the very quick noise you can see with some candlesticks. But it helps to read candles as is and wait for closes. But Heikin-Ashis are pretty easy to take out some of that noise.
Sure. Yeah, that is a good point too. I sometimes will pull that up for charts that are more noisy, like TLT, for example, on a daily chart can sometimes be really hard to look at. It's so choppy. But if I switch over to, where is it?
Right above, you got it right there. Yep.
Yeah, see, you can smooth out the chart a little bit, make it a little easier to look at. Speaking of TLT, again, thought process for me on this one is that we're sitting at a level of resistance here at right around that 93.30 level, let's call it. If we again get some follow through here today and we do see price break through the highs, I will be looking for a chance to sell calls if we get a clean big solid break. I would say if we rally into the close today, I'll probably just take that as an opportunity to set a take profit essentially and get paid to do so. So I'm fine with that as a potential option. Yields are down 2% on the day, bouncing just slightly off of this, and then the 2-year and the 10-year, same kind of story. You mentioned Bitcoin, Ethereum. It's so funny to me sometimes, Chris, when people who are the crypto super fans, they hate to admit that their beloved thing is susceptible to the same winds that other markets are. I mean,
Totally.
yeah, right. Bitcoin is
It's
just a
not
risk
immune at
asset.
all. At
Yeah,
all.
it's not
Yeah.
immune at all.
Yep.
There's no it is incredibly correlated to other
Yep.
risk assets. It is not safe from traditional finance as much as people would love for it to be. So, I mean, it is. I mean, now it's an ETF. At this point, it's practically a penny stock.
Yeah, well, and you got to wonder too. I mean, I don't know if these approved ETFs are kind of sucking the life out of just the spot market, the futures market. If it's just going into like the buy and hold scenarios now, the price action has been a little bit different. Obviously, Bitcoin was pumping on the pending approval, and then it happened. We had the pullback, and that was a good opportunity to buy a dip. So I'm wondering if Ethereum does the same thing. If they approve it, it dips hard, and then there's another rally to the highs again. But like I said, little micro futures is pretty solid. I want to address one question. I think Jake was asking, what do you guys think about the yen crosses the dollar yen? I'll say this like I've said it for months and years. I hate the yen. I think right now the yen is one of the dumbest currency pairs to trade, unless you want to scalp it, just because you're waiting on a central bank to have some type of massive manipulation or intervention, or you're waiting for what is going to be more troubling is going to be this massive deleveraging and unwinding, which we saw back in 2022, which we saw back in 2020, which we saw in the end of 2021. That's the carry trade unwinding. And if the yen's going to get significantly stronger over a 3 to 6 month period, it's going to have to be with trouble. It's going to have to be with risk off trading. And right now, I just don't see that happening. I think there's too many positive signs happening. The Nikkei is up for the first time in 34 years to all-time highs. The yen is arguably still weak. The BOJ has no real end in sight. They just came off negative interest rates, but you're just seeing way too much intervention manipulation on the yen basket, and I think it's almost impossible to know what it wants to do outside of look at the higher time frames like a daily, weekly, and look for something so obvious. If I'm looking for yen strength, it's going to have to be just a massive topping pattern, or some type of like really obvious way to place my trade and kind of position for it. I want to bring a couple things in here, Nick. So I'm just reading this, Fed projections. So we have the 4 to 19 saw no rate cut. That was we went through that divergence, but it shows here policymakers see end of 2024 PCE inflation at 2.6 versus 2.4. So actually, the forecasts are going slightly higher for PCE inflation, and then you go to your PCE and core PCE 2.3 versus 2.2. So those forecasts are slightly higher than expected, and you got to wonder, okay, so inflation came out slightly better than forecast today. Market got really excited, but here we are projecting by the end of the year that PCE and core PCE are going to be slightly higher, not by a lot, but enough so that they're not below 2%. They're not near the target that the Fed's been talking about and just trying to reiterate over and over again, 2%, 2%. I mean, we're a long ways from it, dude. 3.3, 3.4. We're a long ways from 2%.
Yeah, and we've been hovering at this level for many months too. I mean, we've
Mm-hmm.
not really broken under the threes and stayed there for a while. And not to mention, if they see inflation going to that speaks as well to their expected rate cut plan. To some degree, if it's like if they see inflation coming down less than what the market kind of consensus is, they're the ones who make the decision, not the market. So
Right.
that's the interesting dynamic there as well. No huge move, but again, I would imagine that even if you do see some movement, Chris, in the precursor to Jerome Powell speaking,
Mm-hmm.
unless it was just a bomb drop, probably some volatility both directions just while we wait for the big thing. But
For sure.
when he speaks, I mean, there is the potential always for huge moves in either
Yep.
direction. So we will see
Yep.
what he has to say. It doesn't take much. I mean, where there was one meeting, Chris, where I had to hop off to do a podcast session, and Frank, I left him because I was like, there's nothing else happening, but Frank, just stick around. Sure enough, like 30 minutes later, after I get off the podcast, the market just made this huge drop, and it was just
Yeah.
like, what in the world has happened? And there was one question at the end of the press conference that he slipped something, and the whole market freaks
Mm,
out. So there's always that X factor, that
gosh.
unknown potential.
Can you just imagine for a second having that type of, it's power, right? It's like if he says the right thing or the wrong thing, he maybe improvises in any way, shape, or form. It's like, man, that guy can 100% rock these markets if he wanted to. I think he's done a fantastic job talking out of both sides of his mouth and making sure that the market has, for the most part, just remain steady. We survived a big deleveraging in 2022, right back to where we, all-time highs. Everybody's celebrating again. Um, and again, it's like, what is his motivation? I really think Jerome Powell doesn't care that we're at all-time highs. I think he cares that the Fed doesn't have to be reactive and backstop something worse. That's what I
Sure.
think is good right now. So that's arguably that like soft landing, no landing. But as we talked about this week, we got a little, I feel like it was more doom and gloom for me to be like, you know what, October 2024, that's 2 years into this inverted yield curve. That's something I'm now aware of that's on my radar. And so I think it's going to be really important how we maybe survive the summer. And typically you have Jackson Hole in August, you've got the September effect, but October, November, December this year, to me, is going to be the most telling sign of where we're going into 2025. If we have a bad Q4, I think 2025 is going to roll that into something worse. If we have a good Q4, then I'll still be short in 2025, most likely.
That makes a lot of sense, Chris, because the Q4 is so pivotal to especially companies like like Amazon and some of the big game changers in the consumer side of things. Speaking of Amazon's down on the day, you get these big companies that do a lot of their sales. I mean, even in our small business world, in November and December and October, those are big months for us too, because those are like consumer times. A lot of people have holiday shopping that they're doing, and so in terms of an outlook for the market, those are really pivotal times. You want to see smashing earnings reports, and
Mhm.
if you don't, again, market market will freak out a little bit. Guys, we've got just about 15 minutes to go here before the press conference. We will be loading up that video footage so we can tune in and react live to that. Currently, S&P 500 had a little bit of a dip. Currently, not moving too much, but still waiting for the main event. The Russell's up 2.5% today. The Dow is just about flat on the day, which again completely erased its gains here this morning. I looked into it, Chris, just for fun. UNH, some of the big names in the
Oh yeah,
Dow Jones
the healthcare.
down
Yep.
0.93%. You have Amazon down today, as I just mentioned. So some of the contributors to this underperformance from the Dow Jones, as you had mentioned earlier, were from some of those price weighted names. So
Sure.
just something to think about. The Nasdaq again exploding higher with no question being led by the semis and technology, software. All three of those up big today, and rightfully so. I mean, if you're going to see rate cuts at some point, those things are going to celebrate it. Same thing with real estate. Real estate's up here today. Financials modestly higher.
Look at your small caps, Nick. That's
Small
probably
cap.
the sneaky winner today is the Russell is ripping. It's actually up like over 2% for the day versus the other one. So
Yeah,
that's a
the
big
winner on the day
plus
for
for the
sure.
small caps to really show like, hey, this rate cut stuff. I mean, and if you zoom out on the Russell and you go to that daily or weekly chart, to me, this is where a lot of old school value is sitting, because there's that very true correlation of only so long does large cap outperform small cap, and we're at one of the most outperforming ratios that we haven't. It's been so extreme. Like we go back to like 2001 2002 was the last
Mm-hmm.
time that large cap outperformed small cap to this degree. And so for me, we're talking about the Dow Jones hitting all-time highs, which has already happened. The SPY hit all-time highs, which already happened. Nasdaq hit all-time highs over and over again. We've seen these hit all-time highs. The Russell has still been chop suey in this area, but if you stretch that up, there's another, I want to say that's close to like 17 or 18% to the upside. Let me see if I go just IWM
Yeah,
for a
about
second.
19% even.
19%. So if we get to those highs, therein lies a pretty good rally. And the reason I bring that up is if you want to see the power of the Russell, go back to Q4 of last year when this thing ripped over 30% and it was 3, 4, 5, 6% better than all the other indexes.
Yep.
So I
Yep.
mean, if it's going to get the broad market push, it really does have a huge performance potential, and and that's why I'm positioned the way that I am. It's like I'm going out to like January of next year. I'm looking to see if the Russell can catch up this year and try to time that trade where it's like I give myself enough time, see if the broader market wants to keep poking higher highs and the Russell plays catch up. Um, Maybe that's the case. Again, it's an option trade. We'll see if it's right or wrong. We're right back where we started, man. I mean, we're what 10 minutes away from the press conference to kick off here. Dollars had a bit of a wick to the downside. Do you want to show your full graph? Let's show all the charts and just see. I think there's just a bunch of noise we've looked at
Yeah.
here the last 19
Yeah. Let me
minutes.
pull it up. Got our all markets view now. So there you go.
Yeah. Yeah, just a lot of wicks. Yep.
Yep. A lot of indecision. Got the dollar bounced a little bit, came back down. Pound and euro dropped and then bounced flat for the last hour or so for most things. But again, probably just nothing dramatically different from the dot plots than what people were thinking. But now on to the press conference, and is this enough? That's the question. Is, you mentioned it earlier, Chris. Is here we are. We've been in this game for a long time with inflation not trending lower. Now you might say, well, today was a good start, and that is true. It's come down a little bit. It's moving in the compass is pointing in the right direction, but there's not like a suspended trend. I mean, take a look at Europe cut rates, right? Europe cut rates, and their inflation has come down, and they've been in a two handle for a while. Here's 2.6, 2.4, 2.8, 2.9. I'm talking about Europe's inflation rate. Inflation rate for Europe was 2.6. Yeah, they started cutting rates because it's seemingly staying below that 3%. It's not a roaring threat, and then here we go. US inflation can't seem to even crack below threes. It doesn't mean that it won't crack threes, but the Fed has made so many points over and over. We're data dependent.
Yep.
Once you actually see the inflation come down, then the market's going to rip higher, I think. And the question will be then, is it ripping higher and wrong about ripping higher because now inflation is falling because the economy's cracked? Or is it the true Goldilocks? Inflation's come down, the economy's going to hang in there. That's the next question. And, by the way, Chris, if that happens, if inflation comes down, but the economy hangs in there, Russell to the end, that is the growth plus good inflation story that
I want to see if I just did a comparison. I'm trying do we have that on the Edge Finder? If you did like Russell over NASDAQ, could you see just even if like the last like 5 years or 10 years, I feel like the performance is just so wide. It would be a pretty classic reversion to the mean, or just give the Russell a chance to catch up. It'd be small cap catching up.
we don't have it on the Edge Finder, but I can do it on TradingView really quick just for
Okay. Just
for
doing like
fun.
two line graphs and overlay.
Yeah, let's do it.
Okay.
SPX versus IWM. Let's do line and line. Okay, so here's your weekly chart.
There you go.
S&P is the white, the Russell is the orange.
Can you throw the NDX on there as well, or the Qs?
Yeah.
Because the Qs will be even higher.
All right, there you go. Qs,
Yep. Look at that.
S&P, and there's IWM in orange. And not usually the indices, during a bull market, usually the NASDAQ's running higher than the others, but usually the Russell and the S&P are hanging together at least.
Yeah.
And, you can take your pick. Most of the time, those two things are moving at least similarly. There are times there's a point where the Russell's actually outperforming. This is 2003 to like 2007. Obviously a good growth period like that. So if you enter into a growth period, there might be the catch-up trade, right?
Yeah. And and again, there's no guarantee because, like I said, we're staring at about 20 years of underperformance on the Russell. But when it has its moments, and this is where we've kind of we've seen the reality that we're at the halfway point of the year, right? And having very few stocks and have high concentration, and we're carrying these market cap weighted indexes to all-time highs. The Russell hasn't done anything. Now the Dow is starting to show divergence because of those top 30. Like, I mean, if you take United Healthcare, dude, it's getting beat up like crazy compared to some of the, I mean, the bigger holdings in the Dow have been poorly performing. So anyway, point is, it's an old school correlation, but I do think there's merit in it because, oftentimes these things are around for a reason. There's a reason there's a 30, 40, 50, 60-year correlation with these things.
Yep.
Same thing with equities and bonds. It's like at some point these rhymes over these years are going to make some sense. And I mean, you bring up a great point. If inflation, and for the US it is certainly sticky inflation, but if we can break that sub 3 inflation and start pushing lower, month after month, I do think that is truly what this Goldilocks is ultimately looking like, to blow these markets up and like blow higher, even, and like the top is off.
Yep.
We've hit the top, 24, 25 times, but if we blow the top off and it's another, 10, 15% to the upside, it's scary, but it's also the market can remain irrational longer than traders remain
Oh
solvent.
yeah.
But
Yeah.
man, it'd be spot on if we do
Well, the
see the
Russell
inflation
would be
data
the
dip sub 3, the Russell would be a great catch up trade for sure.
yeah, the Russell would be the play if you get a trend of inflation to the downside that forms, but you
Yep.
also keep the jobs figure okay. That
Yep.
those are the two variables, and that's what the Edge Finder is programmed for, specific. For the Russell to get a great score on the setups. The thought process on the Russell is economic data hang in there, inflation come down. It's going to be
Correct.
rare, but for the Edge
Yeah.
Finder to give it a really bullish score, that's what it would have to see. It would have to see inflation statistics, healthy, looking okay, improving, headed in the right direction, and growth metrics, GDP prints, and PMI numbers and employment numbers coming out hot. That is specifically how it is programmed. That's a great opportunity with 5 minutes to go, guys, to remind you that our 25% off sale is ending soon. If you guys have not picked up a copy of the tool, 25% off if you use the first link in the description, or we'll drop the link here in the chat. If you guys haven't picked up a copy of the Edge Finder, again, it is 25% off right now. If you click this link, speak with a rep, you get 25% off the Edge Finder before that sale ends today. Get yourself a copy, trade with data, use the same tools that we're using each and every day to find trade setups in the market. And again, Chris, we're counting down here. 5 minutes to go before we hear from the man himself. Let's take a look at the heat map. I'm just curious. So
Yeah.
look at, dude, Apple is insane.
I
Apple's
know.
up 10%. And I'm gonna be the first one. Call me a bear, but I just don't like Apple 10% up in a week with no like grand slam new products. That's my opinion.
Oh I mean, dude, the last 48 hours, that is insane on Apple. Outside of the fact that maybe this is the market's admission that, hey, look, we got it wrong at the beginning of the year. For whatever
Maybe
reason,
so.
right? It's like this is the market playing catch up with one of the most competitively advantaged stocks that we have, the number one stock in the world for so many years. And all of a sudden the market's like, well, you guys are having a problem with China and you haven't innovated. Well, all they had to do is talk about AI. And again, I read the information on the WWDC or whatever. People were disappointed about their AI talk and the space. And Elon Musk is being vocal about, if you do this with OpenAI, I'm going to ban it for my company. I mean, again, it's drama, but look at price. This is Apple catching up in a big way, where the market hated it at the beginning of the year, and now,
Yeah.
I mean, this is one of the biggest rips that we've seen. I mean, for a stock that essentially is a safe haven tech stock, this thing's up 33% in a matter of 2 months, man. That's impressive.
It
So
really
I'm just
is.
glad that I was long, dude. I own this thing at like 167.
That's awesome. I got
Yeah.
caught in the camp of I'm going to buy it at 155, and I missed out on the
Okay.
155. I got, because it's a company I think I want in my portfolio, but I
Mhm.
wanted it at the right price and at that time.
Yep.
And to be honest, still I'm a little bit like, okay, the revenue for Apple, I would like to see revenues growing. I mean, I know you've had revenues in their services, specific sectors within the company have been growing. That's good, but I'd love to see growth on the numbers for this company.
Mhm.
You've had pretty stagnant revenues for the last few years, but maybe AI is going to take them there. I don't know. We'll have to see, and maybe those new products are going to be a game changer for them. But we'll have to see, guys. We are just about 2 minutes to go here, or even less now, from the press conference. James has it loaded up for us. Once we have Jerome Powell speaking, we'll take over the screen so we can watch it. Chris, you gonna hang around, or you want to
Yeah,
hop
yeah.
off?
I'll hang out, man. I'll hang out
Okay.
because I want to see what happens with the. I mean, I'm in, dude. I'm in for the next 90 minutes because I want to see if these trades, these Euro DTEs, give me something by the end of the day.
Okay, sounds good. Yep, we're getting close here. And as soon as we have that feed, we'll pull it up on the screen so we can all relish in Jerome Powell's,
let's just bask in
speech.
his greatness.
Yes, exactly. The man himself. But
One thing I want to note real quick on the SPY, I'm getting some gamma levels printing up around 545. So this may be calling in some levels institutionally where we can start breaking some highs in the day and get up to 545. So
all
that's just
right,
what I'm seeing in intraday right now.
542.78 on the SPY. SPX is making a push higher. It quickly erased any sort of pullback that was there. You've got the Russell doing sort of the same thing. NASDAQ back towards the highs. Gold catching a little bit of a bounce as well. TLT doing its thing. Bitcoin up 2.77% on the day. Volatility everywhere, that's for sure.
Yeah, definitely. Open the floodgates. That's what today's type of trading days are all about. Just everything wants to move.
Yeah, it has the potential too with PPI tomorrow, just continued volatility this week. I mean,
For
we'll
sure.
probably see some wild swings one way or the other. And I should mention with the PPI tomorrow, you want to also watch out to make sure that producer price index doesn't come around the corner and spook the same, hype that came out today, right? If you get a really
Right.
hot producer, that happened the other day, one of these other months, there was a producer price index that came in really hot, and then CPI came in and cooled it all off. So
Mm-hmm.
you can get the other way around as well. So we'll have to see what happens with that tomorrow. But we have a feed, but Powell's not yet at the stand. So as soon as we have that, we'll pull that up for everybody.
Taking his sweet time.
Keeping us all on our toes. That's all he's doing. He's a likable guy, really. I do actually like Jerome Powell. I think he's a nice old man.
It's been fine. I like him better than Yellen. I mean, Yellen's press conferences were terrible to listen to.
Yeah,
So
I agree.
just like a bridge troll.
Oh, here he is.
All right, there he is, the man.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one that we saw this morning make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summer of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls, but we ask them to write down the most likely one. So they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all of them as plausible, but I'd look at, I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier. We want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because really it's going to be not just the inflation readings. It's going to be the totality of the data. What's happening in the labor market? What's happening with the balance of risks? What's happening with the forecast? What's happening with growth? You look at all of that, and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response, which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that, what's in the SEP actually does reflect the data that we got today to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Janelle.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed. And what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability banks in leaving rates where they are for too long at this point?
on housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters. And I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that, we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year. And I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. I'm just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there were renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply as they did at the beginning of when the economy reopened. They really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward. Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of, is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So, and also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PCE readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PCE as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's the whole. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things, because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE. We're at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. or there's another test, which is, an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And, we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
All right, I'm unmuted. Chris, you're unmuted. All right, Chris, what'd you think?
A big old nothing burger, dude.
What's new about it? That's the standard. Is
I think that all of that talking and clearly talking both sides has really allowed the Fed to operate in this area of we're going to stay between 2% and 3%, and the Fed doesn't have to do anything. That's kind of where we're at.
Yeah, that's an interesting take. I mean, it moved down a little bit and then it jumped back, and it looked like it was taking out the highs, and now what is the sell off is after the fact. So I don't know. It's an interesting event. I thought it was interesting that they pointed towards expectations for inflation staying pretty much higher for longer.
Mhm.
But at the same time, so this consensus now is one rate cut for this year. It seems like from the Fed committee, I saw that when I was watching. I pulled up some news, found one
Mhm.
rate cut is kind of the consensus now. Again, a weird move here where we're seeing the stock market back and forth. Gold came down. The dollar is up at the same time. Very, very strange there. But yeah, it seemed like a nothing burger because you had conversation in both ways as always.
Mhm.
It's, we don't want to hurt the economy. We think we're restrictive enough, but at the same time, we still have to work on inflation. We got progress to make. So
Yep.
it's kind of the standard Fed meeting these days.
Yeah, and look, it's June, right? So June and July, FOMC minutes in August, September's the next big one. Um, it we could be in for a summer of nothing from the Fed. So I mean, data tomorrow with PPI, that's going to get things a little bit more exciting, good, bad, and different. Yeah, really, I think it's just difficult unless you're a futures trader or unless you're just in and out of the market in the first 15, 20 minutes of the day. Everything was contained to about a $2.50 to $3 move today. By the time we
Yeah.
opened, it's like everything was tight. Everything was, I mean, Dow was coming back up and it's starting to fade that again. I mean, there's obviously a little bit more price action post press conference now. Just shy of that 544 handle. Kind of poke the bulls to the upside and just drop again. Look, we only have 35 minutes for a closing bell. If this thing dumps, $3, $4, $5, that'd be a bit of a surprise, but it'll probably come right back down towards 541.25 and just bounce there and finish right in the middle. I mean, if it does something bigger, great. If it doesn't, I just wasted $148 today.
Well, yeah, what'll be interesting too is it almost is like the data is all that moves the market. The Fed meeting is just this noise. It just back and forth. And I don't know. I thought it was interesting that he kind of downplayed the inflation report this morning a little bit, but at
Yeah.
the same time said that it was improvement, but he's like, we're still not, not there. And I don't know, very, very mixed, but kind of the standard, I guess. Consensus is next event is really PPI tomorrow morning.
Sure. And I think for the press conference takeaway today of the, what we've been live for an hour and 40 minutes or so. You guys have been live all day. I mean, there were a couple of questions in there of all the Q&A where I was like, that's a good question. But he is just so good at
Lock and key,
answering.
man. Lock and key.
He's so good at answering the question without giving any information to anybody.
Yep.
And, and I'm sitting here, I mean, we're sitting here watching price. And look, the conference is done. This is the best direction that we've actually had in the last 5 or 10 minutes is actually watching about a $2.30 drop on
Yeah,
this. I'm
right.
just watching the SPY on my side. But if I show my screen really quickly, this is what I've been staring at all day. This is the 9:30 to 10:30 range, and nothing is breaking out of it.
Yep.
So again, what I should have done is nothing. I was like, well, the Fed could pop this thing up. I was seeing some gamma levels up to 545, but Powell just said nothing that the market got excited about. The market got excited ahead of the Fed, right? It was all about and that was a subtle improvement, but again, we're essentially just going to live and die month to month by the Fed right now and by CPI and all the data. I don't know, man. I mean, it is what it is. I'm happy that I'm up for the week. I took a lot of the drama out of the FOMC today. I was already in profit by 10 o'clock this morning, so I'm thinking here for the next 33 minutes, if something wild happens, then sure, I've got some exposure to make a little bit of profit there. But for me to make money, this thing has to dump back down here pretty aggressively towards 539, 538. Otherwise, if it chops around and stays in this range, I'm toast for the day and I just wasted money. But otherwise, it's just it was just a trade. We'll see what happens, but it's noise, man. And crazy day, man. You had all the indexes up. I mean, gold is down, dollars up, Dow's all over the place. Q's broke the highs but faded back in. SPY didn't break out of an hour range all day. So
Yep.
what are you gonna do?
Crazy. Very, very odd day. I mean, as you mentioned, gold completely erased all gains today. Yields telling a story. Yields bouncing here a little bit as we kind of close out the day. That's likely what is driving the TLT position back down, gold back down, and some of the Dow stocks as well. The S&P 500. We'll see if it makes any sort of substantial move. There's one for me, Chris. There's one saving grace on the day. I mean, I'm
TLT?
up on the day still, but wait, what'd you say?
Did you say TLT?
Well, TLT's the one thing that's going
Okay.
pretty well
What's
for
your
me.
saving grace?
The saving grace for me would be if we get a little bit more downside volatility. My calls I could probably work my way out of, but
Okay.
we'll have to see. I mean, I'm kind of good either ways. If I take profits, I take profits. If not, I don't. But Chris, I'm sure we'll have you back later on this week. We're going to be, of course, streaming all the major events for the rest of the week. And thank you for hanging out for all this time on the air with us. And I want to just say to everybody who's listening here live with us, make sure you guys go follow Chris on his own social medias. We'll drop the link to his YouTube channel here now so that you can go find him there. You can also find him if you're watching on Twitter. We got a bunch of people watching on Twitter right now. Find him at Real Chris Pulver. Make sure to throw him a follow. And Chris, thank you very much for coming on the show today, man.
My pleasure. Thanks. That was fun.
All right. We'll see you tomorrow.
All right. Thanks, Nick.
All right, guys. And kind of closing out the show here, we've got a little bit of volatility to end out the day. The S&P 500 again selling after the fact, but what a green day overall for stocks. But we'll have to keep an eye on it, guys. We streamed for 7 hours and 16 minutes. That is a world record for the A1 Trading Show. It's the longest we've ever done. To close out the show, I just want to give you a last call. Remember that the Edge Finder, if you're a regular stream fan, the Edge Finder 25% off sale is ending. If you have not already picked up a copy, 25% off. Use the link being dropped in the chat right now. Speak with a team member if you want access to all of our different market data. This includes our top setups algorithm. This includes our data scanners for things like gold and S&P and indices. It also gets you access to our commitment of traders data, which is one of the most popular pages on the tool. Get access to our retail sentiment data, all sorts of good stuff. The put call ratio. We got a million different tools and features here. If you don't have a copy of the Edge Finder right now, it is a one-time purchase. You don't have to pay every month or anything like that. And if you use this link that's just been dropped in the chat for you, you can currently get 25% off of the product. Again, it's a one-time fee. It's discounted right now. If you click that link, you'll be connected to a real person on our staff who can help you if you have any questions. So if you have a few questions about the tool and you want more information, you can always chat with a representative by clicking that link. They're standing by to answer and get you set up with the copy if you're interested. With that said, thank you very much, guys, for tuning in to today's live stream. We'll be doing it again. There I go. I'm floating away on the moon here now. There I go. And thank you guys for watching. Have a great day. We'll see you next time.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.